Good morning, good afternoon, good evening, folks. Michael Zuber, One Rental at a Time, and we are back with a legendary investor, Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you?
I'm doing great. So one of the things that I wanted to talk about today, really two topics in our final video, and you could choose whichever one you want to talk about first. One is the notion that we have so much cash piling up in the system. The reverse repo market hit over 1 trillion in overnight lending on Friday. Or you can talk about something you educated me on. Hey, Michael, it is much better to get out at the top than try to call the bottom. You both in real estate and stocks and all this momentum. So I'd love to talk about both of those. We'll dealer's choice, whichever one you want to hit first.
Yeah. We can definitely talk about it. Obviously, cycles are important. You want to talk about that. Number one, you never want to fight the trend, go against the trend. You always want to make your moves with the trend. And as markets are trending up, you want to, make your moves in and out and, lead that trend up, lead that market up. And then when it's on the decline, you want to lead that market down again and stay ahead of the curve. So it's always, most important to know the top, because that's where you can get left behind, right? You're never going to lose money missing a bottom. You're going to lose money missing the top, where you've either bought on the way up or you've bought on the way down, and you don't know where that top is. And, in the housing market specifically, real estate market specifically, how do you spot the tops? Again, inventory levels, days on market, interest rates, those types of things. And we're starting to see some slowdowns here now. So we very well could have reached a peak in the housing market. We could be down the other side of that. Commercial markets, obviously the pandemic's thrown a wrench into all of that. So you really don't know where we stand in the commercial market, specifically office, retail, malls, things like that. There's a lot of damage out there with those assets in the industry. So, we have obviously reached a peak in those before the pandemic. Those assets were peaking. Multifamilies at an all-time high right now in terms of cap rates, things like that. So you want to understand, the different markets, the cap rates, things like that. But, and then financial markets, we are at all-time highs in the financial markets. We're setting records every day. This is the tricky part. A lot of people don't want to get left behind because there's no yield anywhere. So they're being forced into, risk trades, which is, the markets. And as long as the Fed is continuing to do what they're doing, which they've signaled they are, you can expect more upside in the market. The question is, how far can that go and how long? And how far are they willing to let it pull back when it pulls back? Because it will. We're going to get corrections, 10, 20, 30, even 50%. You could call a correction at this point because the markets are so overinflated. I don't even know that you can ever have a crash again. I don't know that it will be allowed. I mean, how can you have a crash if the Fed will step in and start buying stocks?
The Fed put, right? Or don't bet against the Fed. Yeah, that's.
And again, like we talked about in the other video, that's not necessarily a bad thing because it's a lot of people's retirements. So that's a lot of average individuals' wealth that's tied up in the market, not just Wall Street banks. So when they step in and do these things, they're doing it for a reason. It's propping up the confidence of not only the markets. What that does is that reverberates around the world and props the economies of the world up. So unless we want to see economic Armageddon like we've never seen, since the real depression, you got to keep the markets propped up because there's just so much relying on that. And that's really what they're doing. That's a form of stimulus in and of itself.
For sure.
In terms of people's retirement accounts. That's really a lot of what that's all about. It's not just about, making the bankers rich. Unfortunately, that's the result of a lot of it.
Yeah. One of the things that I read over the weekend that scared me, it literally scared me. I read it. I kind of had to take a pause is we have more leverage in the stock market than we had in 1929. Right. And if you don't know the history of 1929, that's when the whole shoe shine boys were basically getting their leverage was insane, right? It was $1 to $100 they could invest. It was crazy leverage. And I forget the number, but $850 billion 850 or was it a billion? Anyways, crazy leverage today. And to me, it just feels like the retail investor really came to play in the last year, right? Robinhood and like exchanges, Robinhood just went public. It just feels like retail investors are all in, which for me is a history lesson because I did the .com craze and got caught up in it and lost a ton of money. It just kind of feels like we're getting close to that. And again, not advice. It's just a history lesson for me. I don't have $1 in the stock market, so why listen to me? But man, when retail is all in and you got Wall Street like Jamie Dimon saying, I've got $500 billion and I'm not going to do anything with it. I'm just going to let it sit there and inflate away. that kind of tells you something. At least it tells me something. I don't know what you take from that.
Yeah, it's very, very interesting times. And, again, there's no yield out there
Yeah.
and everybody's worried about the economy. So on one hand, the only yield is in the markets. On the other hand, everybody knows the markets are way overinflated. Everybody knows that there's, a lot of rehypothecation going on with bank reserves. So when you put money in your local bank, it doesn't stay there. They put it on deposit with the Fed so they can in turn loan that, back out and lever it all up. That's where the leverage comes from. And that's where, this whole reverse repo and all that stuff comes from in the repo markets. It's really, really interesting times in terms of how the institutional investors are viewing things. And you're seeing that in bond yields, going down, you're seeing that in cash balances going up. It's very, very interesting times.
Yeah, when I kind of see smart money, and for me, Jamie Dimon is one of the best investors out there, right? Kind of like the CEOs of the big banks. When I see him again come out 2 months ago, we talked about it 3 times now, I think you and I, and say we have $500 billion in cash and adding 50 billion a month, I think it was, and we're okay with that. That tells me something, and that tells me that Jamie Dimon is willing to wait until there's an event. He doesn't know when. It could be this year, it could be next year, but Jamie Dimon is happy to wait, and that gets my attention.
Yeah, he's not the only one, and he was there. He had a seat at the table.
Oh, he did.
When all this was going down in 2008 and 9, so he knows exactly what's up. And when you look at a $1 trillion repo market, when that's rehypothecated, that could be 100 trillion.
Yeah.
That's what people don't know. That entire market could be levered up. Rehypothecated means, you put it on deposit with me, so I in turn let you loan back out tenfold. Then you turn around, put that on your balance sheet in 4 or 5 other different areas, and that gets levered up tenfold. Kind of like the housing market with the CMBS and the derivatives that were created
CDOs and all of that.
CDOs. Yeah. So a $36 trillion housing market was actually levered up 100-fold.
It was.
That's why that was such a huge thing.
Yeah. Yeah. Crazy stuff. So the other, again, it's all this cash in the system, at least for me, is one of those kind of yellow light warning signals. Because again, if the smart money saw opportunity in a no yield environment, they would go there, right? But they've also been in the game. Again, I remember Jamie Dimon in the lot sort of parading the Wall Street for the TARP conversations. I remember that back in 2008. So he's been there, done that. And again, Jamie Dimon knows he can wait, right? He's willing to let inflation eat away 2, 3, 4, 5% because he thinks he's going to get a 20 or 30% discount on the other side.
Yeah, I mean, there's no real inflation if everything resets and values go back to about half of where they are now across the board. Is there, where's the inflation there? So, inflation is a misnomer and it's not a real thing over time. I mean, I guess it can be when you look at the price of assets, but everything will come back down when the economy contracts. The question is, can we get real inflation? Are we going to really see stagflation? Everybody has too much money and they're not willing to lend it out. So to create inflation, the average consumer needs to be able to borrow money. That's how they consume. Nobody can get credit right now. Credit's contracting. Yeah. So banks aren't lending. Yeah, and banks aren't lending for a reason.
Yeah, that's another thing. I talked to a mortgage lender, actually 2 of them. One is a traditional owner-occ lender and one is a non-QM lender. And yeah, lending is tightening. Again, bank FHFA, Freddie, Franny, even Ginnie Mae, they're tightening up. And if you're not, you can watch the market, real estate market, but if you're not watching the lending market, at least with one eye, it's a prediction. And right now lending is getting tighter, which means you're going to get less yes answers, right? So the money supply is going to slow down even more.
Yeah.
Yeah. So interesting.
The reverse repo market's the big one that a lot of people are concerned about, but the Fed just did something very interesting with that. And Danielle DiMartino Booth talked about the move recently that he just made that was very interesting, which means he's extremely concerned, but didn't tell anybody about it, hasn't, really broadcast that message. So if you're interested in that whole conversation, it's all of that's over my head, in terms of digging into the deepness of what all that means. But she did a really interesting, layout on that. I think it's on her website where you can read about it.
And what's her name one more time?
Danielle DiMartino Booth.
Yeah,
She was actually with the Fed at one point.
Yeah, she was with the Fed during the TARP crisis of last time. She was not a voting member, but she was a contributor. I think it was the Dallas Fed, I think. Yeah, she is a wonderful interview. I hope to be a big enough channel one day to interview her because she is.
Yeah, she worked with Jay Powell, and
yes.
So she's got a pretty cool inside track on all that, and
she does.
She's got a website where she puts out newsletters, things like that. But she's also, you can just Google her name in YouTube, and you'll see these interviews come up. She's on Fox News a lot, CNBC, that kind of stuff.
Yeah, I think I spend probably an hour a week listening to interviews of hers because she's. Yeah, a lot of stuff she talks about is even above my head with an advanced degree in 30 years of looking at this, but she gives me enough stuff to go, ooh, I better watch that. So this has been a great conversation. Greg, how can people follow you and be part of your world?
Yeah, gregdickerson.com. I put out content every day, so go check it out. gregdickerson.com. My YouTube channel, podcast links are all there, and I look forward to seeing you.
Yeah. And again, do yourself a favor. I follow him. He talks about a lot of stuff that I do not have experience in, being an entrepreneur, ground up development, Bitcoin, all these things that are important. I stay in my lane, but I follow excellent investors like Greg. So thank you for all you do.
Yeah. Good to be here, Michael. Good to see you.
Yep. We'll talk next Monday.